right. Good morning, Florida.
Good morning.
Robert Murillo, broker associate with Team Aroa at Compass. License number BK3373543. Here with my man John.
Good morning, John Sepulveda, NMLS 1309244 from Origin Point, coming at you from Orlando, Florida. Ready for another day.
Florida. You're on the east side. I'm on the west side.
Let's hook
So,
up in the middle.
mm-hmm. All right. Today we're going to be discussing tips for first-time home buyers, what you need to know. But before we get into that, I can't wait to hear, John, what you have to say of yesterday's market and the whole results after the 2 p.m. What do we got going on with what the Fed did yesterday afternoon, and what's your take on it?
So I was thinking about it yet last night, right? So I was kind of preparing, and I actually went back and saw the episode. It was yesterday's episode. I kind of said, all right, here's the scenario. Here's what happens if it happens. So the Fed raised the rates 25 basis points.
Okay.
And he gave his the press release and then the press conference afterwards, and basically said that inflation was a problem, that we need to continue tightening, and hinted at another rate hike that was already projected for the May meeting. So what that did was that he basically said inflation is an issue and we have a problem, right? So as we
Mhm.
spoke yesterday and the other times we spoke this week, he was really, no matter what he did, it was going to have a negative reaction because he just kind of painted himself into that corner. So
Yeah.
he chose he had to pick between fighting inflation, which is what he's been saying he's doing for a year, or worry about the banking infrastructure. And he chose to continue with the inflation fight and said in his speech that the banking system was resilient and it was okay,
Mhm.
which is not true. So, the issue at hand is, as I said earlier, and at some point, probably, I think it was on Monday's explanation, he's driving forward, looking at the rearview mirror. And he's looking at the data, and he knows, because he said it yesterday, the housing, that the chart I showed with the lagging indicator and the difference. And he said yesterday in the speech, it's, housing is lagging and it's 44% of the report, and the report's coming up. He didn't say May 10th, but he said it's coming up and it's gonna, so they see the data. I mean, it's not the data that I've been talking about and I'm reading. It's not a secret. Like, it's out there.
Mhm.
They're just choosing to look at it in a different way. So what happened? He raised 25 bips. So now the market, at first, kind of the market reacted well and started buying, and then reality kind of set in and people started taking money out of the market. And the Dow was down a lot yesterday. S&P not as much, and the Nasdaq, but the Dow was, and the mortgages are, the S&P is kind of the index that's kind of more in tune with in the mortgage kind of
Mhm.
environment. So rates did drop yesterday, and there was a reprice after the speech with when the pricing, because the mortgage bonds started going down. They ended up at 349, I think. I believe the final, they kind of went down a little bit and then creeped up again, but they went down the 25 bips yesterday, the 10-year bond. So that caused the midday pricing for the better. So pricing changed yesterday and it was better for the rates. So
Mhm.
that's where we're at now. So we're now, the next shoe to drop is waiting what happens in the banking system. And is there going to be, how fragile is it? There's a couple of other banks that the stock, was tumbling yesterday. People are concerned. People are afraid. They make a run for their money and try to get their money out. Now, what analysts are saying, there are a lot of other banks that are in the same boat, and we don't know what's going to happen. So we'll see. As I said yesterday, the yesterday at 2:00, you're going to mark the line of the sand as the day that kind of the thing shifted. So we'll see. There's been some effect on the dollar. The futures are predicting, the dollar is dropping 6 days in a row. So
So
that's going to affect the currency.
you made a you quoted him saying that the bank system is resilient,
Mm-hmm.
but you disagree with that. What makes you disagree? Have banks not collapsed before?
Only three in our history. Lehman Brothers in 2008 and SVB and Signature in the past 2 weeks. That's it, man.
Really?
We've had more bank failures in the past 2 weeks than we've ever had before.
Really?
Oh yeah.
What about what everything that happened during the Great Depression? Was that not considered a bank collapse, or that was just
I mean, I haven't seen any data speaking of it. I mean, all the data I've seen, it's Lehman Brothers was the first that I was ever aware of. You know what I mean? And that's everything I've ever heard is, the headlines with Silicon Valley was the second largest bank to ever fail since 2008 and Lehman Brothers. That's, and then
got it.
Signature is the third largest. So there's definitely the banking, because it's, what I explained, right? The banks, they take the deposits, they only keep 10% and they invest 90% because that's how they make the money. They invested the 90% a lot on bonds because they're secure. They're, it's a secure form of, putting your money, right? Investing your money. The problem is that, if they bought a 10-year bond at 2%, and now the bond is 3.5%, the one that's worth 2% is worth a lot less because the one at 3.5% is worth more. So an investor is which one are you going to pick if you're going to put your money? Because they sell those after. So that's the problem. They have a whole bunch of bonds that have lost value because the rates have been increasing. So the one that caused that, the entities that caused that are the Fed. So in their fight to fight inflation, and the only kind of playbook that they know or are following to fight inflation is they're assuming that if you beat down, demand, so if you make things so high, so expensive, borrowing so prohibitive, people are going to stop borrowing, and they're going to stop the demand. And if the demand stops, then the prices are going to go down, right? That's what inflation is. So the theory is, I fight inflation and things will be okay. So I need to fight inflation. I got to stop lending. So no, people cannot borrow. I got to make it so expensive to borrow money that people are not going to borrow any money and not going to buy anything. That's really what he's trying to do. And at the same time, the other indicator of reduction in inflation is high unemployment. So if you have high unemployment, people don't have jobs. That means they don't have money. That means they don't have money to spend. So high unemployment also brings down inflation. And he said that in all his speeches.
Even more important, right? I was talking about this with a buddy last night. Not only do they not have money to spend, they don't have the money to maintain.
Correct, because I mean, we can have another podcast on that. You can see it, like the savings, the amount of people's savings is the lowest like in history, right? It went up during the pandemic, and you can see there's a graph that I seen from MBS Highway that shows you like with the 3 stimulants and tied to savings account nationally. And when the stimulus checks came, you could see the deposits, and and then when they stop coming, you can see the drop just go down on the chart, the savings, right? So
most people die with less than $1,000 in the bank.
Yep. And so they had some money, but now it's at the lowest. And then the other thing that's happening at the same time is that people are in the amount of credit that they're into, people is the highest ever. So during the pandemic with the extra money, and remember, right, this whole bunch of people got out, especially in other states, like a whole bunch of extra money. They just about, I want to say 3 weeks ago, they stopped, like SNAP was an additional resource that they had given people, some, for like food, additional, like a stipend for monthly for food, $300 something. No, it wasn't but it was a significant amount that they've been giving away to people. They only stopped that like 3 weeks ago. So you know what I mean? So people were still getting extra income. Remember, during the pandemic, they increased the amount of unemployment. So when people started going back to work, especially like in the service industry, they were making more money at home, not working, getting the unemployment with the extra benefits that the government provided. They got a higher income than they did when they were working 40 hours a week.
Yeah.
I have friends in the hotel industry, in HRs that I've spoken to that, during the pandemic, he's like, John, I can't get people, they don't want to work. They cannot work. Like they make more money.
Were you able to pre-qualify those people for a loan?
No, because that's not continuing for 3 years. But you know what happened though? You know who did qualify people that like that using that money for loans? The car industry.
The what? Oh yeah.
Car.
Oh yeah.
So there's another thing we haven't even talked about that. There's another, the housing bubble in 2008 where all these
Ooh.
houses, we're gonna have the same thing but worse with the car industry.
Oh, that
You wait and see.
the repo's already started. We're gonna talk about that next week.
But it's not even like I mean they basically gave a car to anybody.
Yeah, no.
Anybody. So now they're gonna start feeling that. Now they're gonna start feeling the pain. You know what I mean?
Yeah.
So that's another thing that's coming. But going back to the banking, and so now you're gonna start seeing is you have issues. Commercial real estate is a big issue. There's a lot of office buildings, a lot of commercial real estate, people not going back, like, people working remote. There's a lot of empty offices and people paying rent. That's another thing that's coming, the commercial real estate side. A lot of the commercial banking is done by small banks, right? So you got large banks, you got 4, then you got regional banks like the Silicon Valley Bank, and then you have your small banks. And a lot of the local small banks, a lot of the commercial lending is done by those banks. So now money's tight, the bond, all the stuff. So they're going to start tightening lending. People are going to, because the capital is going to be much, much more restricted. So people are going to be tighter, and the smaller banks is going to make it tighter for people to get financing and loans.
Okay, so that's going to bring us to our topic now, which is tips for first-time home buyers, right? Since lending is going to get tighter, people are losing their jobs. It's going to be harder to maintain, or I guess not harder. It's going to be more challenging to maintain, yet alone get a loan. So we're going to talk about a few tips for first-time home buyers on what you need to know, but we're also going to, discuss like, all right, with everything that is happening on the market and things getting tighter, lending, I guess, becoming more difficult to obtain, or you can still, the process doesn't change. You can still go through the process, but now people are affording less, right? So where you were able to get pre-approved for 450,000 last year, now you probably only qualify for about, or you could only afford a mortgage of like 350 or less, right? So I have a list of tips for first-time home buyers. Now we're gonna go through them. Some of them I'm pretty sure you will not agree with. So we'll exchange opinions on these, and then at the very end, I mean, this is just diving a little bit deeper. We've said things, like the cliche things that we say, just because it's a benefit to our industry, it keeps the economy stimulated. It's always a good time to buy. I mean, in my personal and professional opinion, real estate is never a bad idea. So long as you can afford it, do it, right? But now these are things that, like you said, people are becoming afraid. They're becoming, the more aware they become, the more afraid they become too. So first things first, let's go with tip number 1. Determine how much house you can afford. Right? Before you start looking at homes, calculate how much you can realistically afford to spend. Use an online mortgage calculator to estimate your monthly mortgage payments, including property taxes and insurance. All right, so I have a question that stems off of this. How do you suggest a first-time home buyer looks at the purchase of a home? Purchase price or monthly payments? And do you agree with this tip?
All right, so I'll answer the latter first.
Okay.
I don't agree with it 100%.
Okay.
Here's why. And here's here's how I see the industry, right? And as a lender, when people call me and I have this conversation with buyers, that is sort of the go-to kind of thing that the industry has. How much can you afford? The problem is that if you really look at people's finances, is not how much they can afford. And they use afford and qualify for as interchangeable terms. How much you can qualify for or how much you can afford, right? But there's a difference in those two words. How much somebody can qualify for or how much they can afford to pay is one number. How much people should get into debt is another number. So I may qualify for $1 million mortgage, but that doesn't mean that's a smart idea for me to go buy $1 million home. So
valid point.
that is when, like, the first, like, you know, when an agent tells a buyer, let's see how much you can afford, let's see how much you can qualify for. In my opinion, that's where the conversation starts off down the wrong path, because people are led down the path of how much you can qualify for, how much you can, you can afford $1 million. Okay, and here's a list of properties, go find houses for $1 million. And then the home buyers, oh my God, this is great, right? In times when rates are 2.5% on a 30-year fixed, right? Oh my God, $1 million. Are you kidding me? Oh my God, I can, overbid 100,000 on this house. Silence, I can do this. And, and that's right. I mean, that's how that craziness happened, is because the rates are so low, the payments are so low, people can qualify more, even if the house you're paying overpaying 50, 60, 70, $80,000. So that right there is kind of the first sort of issue. So that's how I answer my answer to that. And then the other two, what should people look at? Interest rate or monthly payment? It definitely has to be monthly payment. The interest does not matter. It could be 2%, it could be 10%. If you're buying a house and the rate's at 10%, I can't say, like I said earlier, my rate right now is, which is hopefully will stay there forever. I'm not doing anything. It's 2.49%. I mean, I just looking at the statement, I smile when I look at it. You know what I mean? It's like, woo, it's like, it's sweet. It's like when I get my electric bill and I got a credit, to the electric company, because I don't, my panels, it's like, yeah. And then I got my electric car. I don't pay for gas. Yeah. Like, you know what I mean? I get happy looking at that. So that's just what happens, right? But I can't say if I was going to buy a house, and let's say I needed to sell this house, or my son or my daughter were going to buy a house, I could never say to them, well, the rates are 10%, don't buy a house, wait until they go back to 2.5%, because that's not going to happen. You know what I mean? So you need to take action based on your current situation and the current rate environment. You can speculate, rates might go down a little bit, but if you step on the sidelines and say, I'm just going to hold until, I can, until the rate goes down to 4%, that might never come. So the monthly payment is what people should be looking at.
Yeah, I've definitely been advising on that. Monthly payment, first and foremost. What are you comfortable with? Because one thing about it is, I've seen some deals where people have overpaid on homes, and then when things may not necessarily work out and it's time to resell, if they don't have equity in that, it's tough. It's a tough
problem.
pill
Absolutely.
to swallow.
Yep. Absolutely.
And I'm grateful I have not experienced putting anybody in that situation, but I've definitely seen it. And it's not pretty when the buyer's looking at your agent like, yo, you told me this was a good deal. What's the deal now?
Absolutely.
So, I mean, this is actually should be, and I'm sure you'll agree with what I'm about to say. This should probably be step number one: get pre-approved for a mortgage, right?
Yep.
A pre-approval letter from a mortgage lender can help you determine your budget, and it also shows sellers that you're a serious buyer. So, real quick, before you comment on that, I just want to remind everybody who's tuning in to follow us on our Facebook group, the DM Florida Real Estate, and subscribe to us on YouTube if you haven't already. And be sure to follow John, and by following John, you can get access to his link to apply with Origin Point. So go ahead, John, tell them what you think about getting pre-approved for a mortgage first.
100%. That should be the first thing people do. As we spoke earlier this week, people go to the realtor first before they go into the lender, and then, they start the process, which is fine, but the pre-approval should be the number one thing. And then I would add, come to origin point, you get what's called a power bid approval. And a power bid approval is, it's a fully underwritten pre-approval. So what the buyer actually gets is a conditional approval subject to appraisal. So when they go put an offer on a house, they're not putting an offer with a pre-approval, they're putting an offer with an actual loan commitment subject to the appraisal.
So what is the benefit of that? How much more a traditional pre-approval, right, versus that kind of pre-approval? How much time does that save you in the process?
But it's not really the time, it's the matter of when you present the offer, right? So if you go as an agent, and you have a buyer and you present an offer to buy with a pre-approval that says, now some lenders have different pre-approvals than others, right? Some just, some verify, some pre-approval, some lenders do not verify income. They just, borrower says how much they make, the loan officer says, okay, they put it in the system, they run to you, get an approved eligible, and they do a pre-qualification. In my world, that in 50 cents used to get you a cup of coffee.
Yeah.
Now it's more than 50 cents because the inflation, but that's
like
just
$5.
yeah, that's a piece of paper that doesn't mean anything, right? So a pre-approval, well, if you verify the income, then that's actual work, right? So I could take the pre-approval, I'll look at it, I'll calculate the income, and okay, you're pre-approved. Problem is, a loan officer is not an underwriter. A loan officer does not make loan decisions, is not able to make loan decisions. So when the process starts, the underwriter looks at the file. I'm sure you heard this before. At some point, it's happened to you. They no longer qualify, and then, what do you mean they don't qualify? Well, yeah, the income, this happened. There's a gap in income. Whatever. There's a million things that could happen, right? So with a power bid approval, so now it's actually a commitment letter. So you submit the offer to the seller for your client, on behalf of your client, with an approval letter, like a conditional approval signed by the underwriter. Your loan has been conditionally approved, subject to an appraisal. So now you're competing with, not at the same level as a cash offer, but you're competing with a cash offer because you're already approved, right? Why does a seller prefer to take a cash offer? Because there's no contingency, there's no lending to deal with. I know these people qualify. Do cash offers come in at full price when somebody puts a cash offer on a property?
Not always.
I would say never. If I'm going to buy cash, I'm not putting full offer. I'm going to give cash. I'm going to try to get it reduced because I'm paying cash.
Yeah.
Right? I mean, just anybody who has the cash to buy a house, if you have the cash to buy a house cash, a $400,000 house cash, you have to be savvy enough to know that and negotiate. Right? Very few.
Yeah.
I don't think somebody's going to put a full offer. I mean, if they want the house, they will. But
I mean, when there was multiple offer situations, most definitely.
right. We're not in that world anymore. You know what I mean? When I was to look, a lot better than I do now that I look old. You know what I mean? It's just, in the past is the past. So now, but that puts you in a place of a better footing, right? So you got the cash offer, you got the approval subject to appraisal, and you have a pre-approval or pre-qualification, right? So now you're fighting with the cash offer. And if there's no cash offers, you are now fighting with a pre-approval. So now, and you go the other way. You put a house, this happened in the pandemic. You take a buyer with an FHA loan and a conventional loan. What offer were sellers taking during the pandemic?
I mean, cash offers are conventional.
Well, no. If you take somebody put an offer, a year ago on a house with a pre-approval and an FHA and a pre-approval for conventional. What offer were sellers taking?
The conventional.
All day long, right? So now buyers, now first-time home buyers, right? Or people that, were getting left.
I mean, it depends because some FHA offers were taken if there was enough on the appraisal gap.
But there really wasn't, and you know what I mean? Like it was complicated. So a lot of people that have FHA loans were left out looking from the outside in, right?
Yeah.
With a power bid approval. So now you go, and then now take the same scenario. You present an offer with an approval subject, or not a pre-approval, a conditional loan approval subject to an appraisal, or another, agent puts in an offer for their, home buyer on a conventional loan. Pre-approval. What is going to be a stronger offer? Assuming both they're the same amount of money, like this,
Apples to apples. Yeah.
It's the one that's subject to appraisal. That's
Mhm.
because it's already approved. Like it's already approved. Here's the signature. So that gives buyer a little bit more leverage. So as far as
It
timeline, it's
appears to be more aggressive, a more aggressive approach. Or
and
or not even aggressive,
no, not aggressive.
more prepared approach.
Correct. More solid ground. So, and it doesn't take any extra longer. That's the same process. You get the documents, you submit it to approval, underwriter looks at it and back, and you have your approval. So definitely get pre-approved for a mortgage and go one better, get a power bid approval from us.
All right. So now this one, number three, I'm pretty sure most lenders are not going to agree with. And I don't know why. Well, no, I get why buyers do this because they're listening to other people, but shop around for the best mortgage rate. Don't settle for the first mortgage rate you're offered. Shop around and compare rates from different lenders to get the best deal. All right, so I already know you're gonna disagree with this. So wait. I want to know why you're gonna disagree with it, and I want to know what time period or what window do people have to shop around for mortgage rates without it affecting their credit negatively.
All right. So first of all, there's no such thing as shopping around for rates. That does not exist. You
Okay.
cannot shop around for rates.
Okay.
That's an oxymoron.
Mhm.
Does not exist because you cannot lock a rate until you have a property to have a loan application. So if you're
Okay.
going to get pre-approved, right?
Mhm.
I'm a buyer and I'm going to get pre-approved today. I don't know how much I qualify for. I want to buy a house. Calling the lender and saying, what is your rate today? Has no bearing on the conversation. Because
Mhm.
even if I told the buyer that's calling me and asking me, what is the rate today? I could, you know what? We got a special today. Today, the rate is 0. They can't use it
Yeah, yeah,
because they
yeah.
don't have a property yet. So
Mhm.
that's not that's not that's not where people, but that's tied to the same thing. How much can you afford? And now people have in their heads rate. What is the rate?
Essentially,
Back when I got into the business, when rates were 10%,
yeah.
nobody ever called me to ask me what the rate was. People didn't call.
Mhm.
What's the rate? Because that wasn't a thing. It
Yeah.
was how much will you lend me? Because I want to buy a house. So now it's switched from what the rate. So calling, if I mean, and then that's the first part, right? You cannot lock a rate. The second part is the rate is not really a rate. Like a rate is just a number. But like I said, I've always said, 5% was 5% 50 years ago. It's 5% today, and it's going to be 5% 100 years from now. 5% interest is never going to change. It's going to be the same amount. You follow me?
Mhm.
What
Mhm.
changes is the pricing tied to those rates that the lenders sell to the investors on Wall Street. That's where that's where the BIPs, the basis points, that's where that comes into play. So the pricing on the mortgage, the cost of the mortgage is what lenders utilize, and that's what determines the rates. The situation now, I've explained this, earlier episode, is the difference on, or why we're having this issue is because the servicing is where a lot of the service release premium, it's a premium that these servicers get to collect the monthly payments from the borrowers and manage those accounts, right? So an investor will buy a loan from a lender or package of loans, mortgage-backed securities, and those mortgages, the borrowers make monthly payments. So those have to be maintained. They have to collect the money. They have to pay the taxes, the insurance, manage the escrows. That's called servicing the loan, and there's a charge for that. Companies charge a premium for that. And
Mhm.
that premium is where a lot of lenders that do the servicing, they make their money. What's happening now, because the rates are so high, if you bought a house in the past, since rates started going up in the past year and a half, past year, if you
Mhm.
bought a house in the past year, you're going to refinance as soon as the rates go down. Like there's no question. If your rate is 7% and they go down to 5%, you're going to refi. You're not going to keep that. So the lenders know that. So they know, and in the servicing, on a 30-year mortgage, people don't hold a mortgage for 30 years, but there's figures that they have, and there's a time, 7 years, the average mortgage that people keep. Like there's numbers so they have projections of how long they're going to be receiving that revenue and how much money that represents to them.
Mhm.
So
Mhm.
because the rates are so high now and people are going to refinance, and we don't know when the rates are going to go down, that's kind of radioactive right now. So people are afraid. So there's a huge difference in the pricing premium that have been built into these rates, because they're charging the service premium up front because they know they're not going to have that paper on their books for a long time because people are going to refinance.
Mm-hmm.
You follow me?
Absolutely. Yeah.
So that's where that's the pricing. So that's what changes. So a lender has a rate sheet. Here's the rate, but there's so much more to the conversation than the rate.
Here's the rate right now.
But here's the rate right now and if you look at the fine print, like if you look at an advertising, go look at the fine print. 740 credit, like really small, 740 credit score, 20% down, conventional loan. That's usually, those are the three kind of parameters to see those rates that are advertised.
Yeah,
right?
exactly.
So that's what a lender will do. What's the advertised rate today? 3%. Hey, your rate's 3%. Yeah, with 9 points.
If it'll get you to do the loan application, sure.
100%.
So
I mean, go into a lending site and you'll see the rates, and you'll see that there's a chart. Like just go to do the exercise after, and you'll see the rates, and then it has that's changed, right? Before, you never saw a rate sheet with a rate and points next to it. Right? You never really saw the rate. Now, because they have to pay points and they have to disclose how much it costs. That's what the law says. So now you see the bracket with point. There's really no lenders quoting no point, or it's called par rates. Par rates means you don't pay anything to buy the rate down. So it's called, or you don't get the buyer does not get a lender credit, right? The pricing is higher. That's where the lender credit comes from. So that's what you see is you don't see par rates. All the rates you see are not the rates paying discount, because people are looking at the lower rates, but they don't really know what discount point means. A lot of people don't know what that means. They just, all right, the rate's 3%. Oh, great, let me call this guy. But that's not how rates work.
So the scenarios, I think there's maybe 2 or 3 scenarios that would make people think they can shop for a rate, right? One, they're listening to other people, right? Like about when they bought their homes. Oh yeah, I bought my home at a 2.5% interest rate. You should shop for rates. 2, they're skeptical of what their first lender is telling them, right? Oh, well, I think he's just trying to get me in the door, and it's the first one I went to, so I just want to shop around for rates. Or 3, how they're being advertised, what they're being told, right? So I think those are some valid points. Essentially, okay, the second part of that question was, what time period do you have to quote unquote shop around for the best mortgage rate before it starts impacting your credit negatively?
So you can, and there's really no, or at least I don't know the actual algorithm, right?
Okay.
But if you shop for, like, if you're shopping for a house and your credit is pulled at different banks, that's obvious that you're shopping for a mortgage. So the algorithm, the hit on your credit is small and short, right? By the same token, if you go and then you pull your credit for a mortgage, and then you pull your credit for a car, and then you pull your credit for a credit card, and then you pull your credit for a personal loan, and then you pull your credit for a line of credit, those are different types of debt. Therefore, that means the algorithm deduces that you're looking to get into debt. And if they approve you in all those places, you're going to get into debt, so your credit's going to score. And that has a big hit on your credit, right? Yeah. So that's really that's really kind of how the parameters work. Is it impacts you slightly, but if you do it within a short period of time in the same industry because you're shopping for a better rate, that's fine. My advice would be, don't do that. You can go online and see what the rates are. Like, you don't need to call a lender to say, what are the rates? And get an idea of what the rates are now. Don't go by that, because what's advertised on the internet is people take that as gospel and it's the truth. And that's not how it works. But at least they'll give you a general idea. It's like with credit, different but related. I talk to Credit Karma. Everybody, a lot of people know Credit Karma. They use Credit Karma. Oh, my score is 850 in Credit Karma. Well, no, your FICO score is 550. Credit Karma is not the same. You know what I mean? It's not that much of a difference, but Credit Karma is Credit Karma is not, it gives you an idea, right? It gives you a general idea where you're at. So if Credit Karma says, you have a bad score, you probably have a bad score. So you got to, let's work on it. That's all Credit Karma really uses because it's a different scoring model.
Yeah,
So
that's what I tell sellers. That Zillow's estimates are to property values, as Credit Karma is to
it's
credit
the
score.
credit scores. Yeah. And I found my experience with Credit Karma is plus or minus 50 points.
Yeah,
That's
yeah.
a safe bet. Plus or minus 50, and you're in good shape. You know what I mean? If you have that in mind, you can. But it gives you a general idea. So you don't need to call a lender and ask your rates because the lender's not going to know. The lender doesn't know what your credit score is. There's loan level price adjustments that go by score. 620 below, you have an adjustment. 640 below, you have an adjustment. 740 plus, you have an adjustment on to deposit. Like they take money away. So this different credit levels have different adjustments that you have to add on. So if you call me on the phone and say, what's your rate? 2%.
So what I tell buyers is the better your credit score, you're gonna get access to, like for instance, I'll tell them at 740 or better, you're gonna get access to the better interest rates that are available at the time that you lock in your rate.
Which is 100% accurate.
Yeah.
But the issue becomes that people get focused on that and just that. And the problem is, and the reality is, that the majority of people do not have 740s credit scores.
Yeah.
That's the issue, right?
It's a dream. It's a dream when they do.
Well, no, I mean, it's reality, right? You have to, but people get just so focused on that there's a lot more than just the rate.
Yeah.
So definitely, so if somebody calls me up and says, John, what's your rate? And I tell them 10%, and then everything online and everybody else is at 5%. Obviously, there's something wrong, but that doesn't really happen. Like that's not really a thing. It used to be a thing back in the in the Wild West in 2008. That used to be like that. People call lenders, they give them, I explained earlier, like they do FHA, they quote people FHA, they apply for FHA, and they get to the closing and say, oh, I'm sorry, you got to do a stated income because you don't qualify.
Yeah.
That's no longer legal. So, people go to jail for that now. So that's not really a thing. Like switch and bait, it's not really a thing.
Bait and switch, yeah.
You know what I mean? Like bait and switch, sorry. You know what I mean? It's not really, I mean, it's there, but you really can't. I mean, the law doesn't really let you go into those. You can't really do that. You can't charge people more money now because they got to lend their credit. I mean, it's much more regulated. So people are not, and it's like gas, right? When, different gas stations have different gas prices. But gas is gas, right? Why are there different gas stations? Because there's different, different premiums. They might have a little bit lower gas here, but then so they make money in the food inside. So, you know what I mean? It's the same thing. The lender might have a lower rate here, but they might have an application fee that's $1,200, $1,500. I don't know. You know what I mean? So they pick up the fees elsewhere. It's not just the rate. So there's a much more in-depth conversation to be had of what is and that goes tied to the first thing that we talked about. How much can I afford? It's not how much you can afford, it's how much are you able to do realistically based on your budget and your income.
All right, so moving along to step number 4, don't forget about closing costs, right? So in addition to your down payment, you need to budget for closing costs, which can include fees, or will include fees for appraisals, inspections, and other services.
100%. And I would add to that, you should have your first month's payment as on top of everything is counted as part of your closing costs, even if your payment's not due at closing. Just for preparedness, that's people say, oh, don't worry about it. Your first payment is not until, next month when you go in. So people buy the house and they have $3 in the bank because they put all the money into the down payment because they're not prepared. They don't have any closing costs. So that's an issue, right? So I advise people try to get your closing cost. I mean, obviously, if you don't have it, you don't have it, but it's just sort of general guidelines that people should keep in mind. Have your first month, you're going to be paying your first month at some point in the future. Have it ready if you have it, obviously. If you don't, then But then if you don't have the first month at closing, you shouldn't be buying that house.
Yeah,
you really shouldn't. If you don't have your first month's payment, and today is March 23rd. If I'm closing on my house today, my first payment will be May 1st. Right? So if I'm buying a house today and my first mortgage payment is May 1st, and I don't have May 1st payments today, I can't really afford that house. I shouldn't be buying that house because I'm going to be struggling. That's how, I mean, that's the conversation I have with buyers, because I'm very open and transparent, because people need to realize, like, oh, wait a minute, maybe this is not, let's look at this, because you're putting somebody in a situation where they're going to, I mean, if in a month and a half, they don't have the money to pay the first mortgage, that's tough.
Yeah, something else that I learned to do over time is, one, I tell them closing costs, they could anticipate it to be between 3 to 4% of the purchase price, right? And then for the appraisals and inspections, I also let them know, like, hey, appraisals can be up to $600. Inspections could be up to $600 or more, depending on the property. So like that, when the quote comes in at 450, 475, 500, it feels lighter than
Correct.
if it was the other way around. And I told them, oh, inspection is $300, but then there's all these add-on inspections.
Correct.
And now the quote is looking like 600. The appraisal, there's something, some type of fee for the appraisal, and it's 550 instead of 300. You get what I'm saying? Things like that.
Yep.
I learned to, like, just make sure they have a little bit more so that it feels lighter when they go in and do the purchase and actually go through the process. So they also feel psychologically, it helps them feel like they have some savings, and it takes a load off of their first payment,
Yep. I add to that, I advise people, like, there's a lot more costs associated with buying a house than the down
Than just
payment and the
buying a
closing
house.
costs, right?
Exactly.
Then you got an ongoing, you got stuff that you got to be paying, you got maintenance, you got other things that as a renter you do not have. And a lot of people are not prepared. What do you mean? And then so a lot of people are not prepared for that. So
I gotta buy my own AC filters.
yeah. What do you mean? So there's a lot more of that people should keep in mind. I did the home buyer course I recorded that, I got a whole section on that. Is here are other expenses. You got to be prepared for these, because there's a lot more stuff than just paying the mortgage.
So we may be cutting it close on time.
Yeah,
but
we should probably continue this and cut it here and then do the rest, or you want to continue, because we are kind of close.
Yeah. Well, I do have a treat for everybody. At the end of this episode, I'm gonna be dropping the song that I put together for the home buying process. So that's something for them to look forward to. So basically, I was able to break down the home buying process in less than 3 minutes over a beat. So,
Really? Okay. Oh.
yeah. So that's
you got me curious now. I want to listen to this. Cool.
I'm gonna throw it when we mix this episode down and launch it. I'm gonna throw it in the mix, and
oh, that's cool. Okay.
People will have that. So number 5.
So you're rapping in the song too? Like, it's a rap? What is it?
It's a rap. It's a rap.
Cool. All right.
So it's gonna be pretty cool. I've actually done buyer consultations with it as well.
Really? Okay. Cool.
Yeah.
Looking forward to listening to it.
Yep. So let's see. Hire a reputable real estate agent. A good agent can help you navigate the home buying process, negotiate with sellers, and find homes that meet your needs. So granted, this is a given. An agent who is local and relatable to your situation, someone who understands where you're at, knows how to ask the right questions to discover your needs, and someone who actually listens to you. So obviously those are typically the most reputable agents, because they build long-term relationships with their buyers and sellers.
100%. And I would add real estate and lender. Because if you don't have the same from your lender, you could be the best real estate agent in the world, and you're gonna have the best buyer in the world, and if you got a not so good lender, things can go sideways. And then if you were as an agent, you have a buyer that already has a lender, right? So you don't have any control.
Oh yeah. We definitely.
But the lender can, like, ruin the deal if you don't have and the buyer just found some guy that told them that the rate was 3%. Oh, okay, and that's messy. And when times get tough like this, the times we are now, people do crazy things. I mean, there's pressure, you gotta put food on the table. You gotta, the plate, with your meals, you want to have food with the meals, you know what I mean? And people get
Yeah,
tight. And if they haven't, sold a house or done a loan, they get desperate and they start, and it's real life, you know what I mean? So you wanna be dealing with people that are professional and that, take the time and listen to what your needs are, and not just trying to sell you something, but to educate you and give you the information so you can make an informed decision.
absolutely. And that whole thing with buyers coming in with their lenders already. I mean, I've learned the hard way. It's important that you open up that channel of communication with that lender. And to your point, not just a reputable real estate agent, but it becomes about in its entirety throughout the whole process, who's on your team, right? Your inspectors are members of your team. Your and I went over this in a for sale by owner seminar. Is like basically, even if you don't work with a real estate agent because you feel savvy enough to sell your home, your team matters. So the lender, the inspector, any other services outside of that, if you're buying a fixer upper and you need contractors, those become members of your team.
Yeah.
So having an agent who has a team around them of reputable people is very, very very important in this
100%.
for sure. So yeah, so pretty much what we'll do is we'll probably stop it there and get back into this because we can get into a lot more conversation with the following tips. But we'll
100%.
still include this in the description
And we'll finish it up tomorrow.
tomorrow. Yeah, definitely. So absolutely. Anything else you want to add before we let everybody go for the rest of the day?
No, I mean, I just think that, this definitely has been a very candid conversation. And I think, I mean, that's what it's all about, right? People really understand how this works, and they get educated, because it's not about, at least in my mind, and I'm pretty sure you kind of agree with this, or you're going to agree with this, is it's not about really selling somebody a house or selling somebody a loan. Like, I don't sell anything. I'm in sales, but I don't sell anything. I provide education and information. And I've had many conversations with a buyer where I said, listen, you should hold off. Like, you should really hang on a second and think about this and do this. And because there's no point in getting somebody in a situation that they're going to be in trouble. It's just not, at least I don't believe in that. I don't live my life that way. So it's being very candid with people, and listening to what their needs are, and really putting their needs first makes for a process. And if they don't qualify today, but a year from now, they may still qualify, and they'll if they start working and they have a plan and they follow that plan, then they can buy in a year or two, whenever it is, right? So it's not about, it doesn't have to be right now, but I think that's crucial that people hook up with reputable, real estate agents and lenders that are really looking for their interest, not just, looking to make a sale.
Absolutely. 1000% agreed. All righty. So I guess that's it for today.
We'll talk
Again,
tomorrow.
yeah, please make sure.
I'm looking forward to this wrap. Oh, don't
Yeah.
put pressure. I mean, don't have the expectation that I'm going to listen to that, and now all of a sudden I'm going to be motivated to do one of those. Like, because it will not work.
Do one from the lender side, right?
Yeah, no, that's not going to happen with me.
I could ghost ride it.
When the Lord was giving out the talents for the musical talents, I was late for that session and I didn't get them. So it's definitely, you don't want to hear me trying to do anything that's remotely related to music or singing or rapping or anything like that, because I'm awful.
That's hilarious. So yeah, so real quick. Oh, so back to that point that you made last before we do end the episode. That's where your financial coaching comes in, is when you see something, on that overview, helping them understand, like, listen, you might want to rearrange and reconsider before you commit to this right now.
100%. I mean, that's, and that, I mean, honestly, that's one of the things that sets me apart from, it's just that I have that that training to be able to look at that and say, wait a minute, what about this? And, oh, I need to pay up that. Well, here's a debt plan, and this is how you do it. And, that makes a big difference for people.
Yeah, absolutely, absolutely. All righty then. So we'll definitely have another episode when we get deeper into the financial coaching stuff too. So Robert Murillo, broker associate with Team Aroa at Compass, Florida, here with John, license number BK3373543, signing out.
John Sepulveda, NMLS 1309244. Talk to you in the next one.
All righty. You guys have a great day. Look forward to tomorrow.
Talk to you later.
Cause I'm out here trying to make it, but I don't know which way to go. And they telling me to be patient, but I can't even play that role. I'm so lost, 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 so lost. Look, yeah. First you gotta meet with a realtor, open up about your needs without a filter. What kind of home you like, what part of town, and depending on your prices, how much you're putting down, what's next? Then you gotta get pre-approved, base of bank statements, W-2s. Now we search for a home once the loan is known, in a zone that you really wanna call your own. This the one? Now we gonna draw up the offer. I call the list agent just to get it up offer. We negotiate the price and terms. When we get it under contract, it's your turn. Now we going into escrow, schedule inspection, renegotiate if anything needs correction. And we move along, move along, move along. I'ma show you how to buy a house through the song.
Then we going straight to appraisal while they underwriting your file. When we get the clear to closing, we gon' go to close with a smile. If you're lost,
You can follow the steps in this verse, and if you still need more help, then call us up first. Cause if you're confused and just don't know the route, then we are the A-team you should know about. Cause I'm out here trying to make it, but I don't know which way to go. And they telling me to be patient, but I can't even play that role. I'm so lost, 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 I'm so lost. Cause I'm out here trying